When it comes to investing, bonds are pretty much the most boring topic you can find, but they are one of the cornerstones of the portfolios we build to help you when we look at your long-term plans. Things have changed in the bond market, and they've changed a lot, and we've adapted our approach. Vince and Evan are here to talk about that next. Hello, welcome back to Wealth Wednesday, our weekly show to help you plan for something better. If you'd like to catch up on past episodes, you can do that on our website. That is cfswb.com and here on our YouTube channel at Commonwealth Financial. And while you're here, if you like this content, please hit that like and subscribe button. Today, I'm joined by Evan Brockmeyer, a financial advisor here in Marietta, Ohio, and Vince McManus, a financial advisor in Parkersburg. Guys, judging by the phone calls we've been getting, we know you've noticed some pretty significant activity in your accounts. We completely revamped our bond holdings, and we wanted to talk about why we made such a massive change. Vince, we're going to start with you. One of the quotes that I love to use, skate where the puck is going. It's a well-used quote from hockey great Wayne Gretzky, and that kind of describes our process in this rebuild. Can you explain?
Sure. Prior to our most recent changes, I'd classify our bond holdings were somewhat more defensive in nature. We were positioned to minimize the impact of rising interest rates, which obviously coming off of COVID, starting at zero, I think was a very prudent thing to do. And in hindsight, it was extremely prudent thing to do in relative terms. Which means basically we're able to minimize some of the price decreases from the rising rates that we saw in 22 and into 2023. But we're looking forward and trying to see what opportunities are presenting themselves in the bond market to how we're investing going forward. So, I mean, really, yields are more attractive than they've been in a long time. At least since 2008. I think you can go back even further than that. But last time we saw the 10-year treasury yield where it is was actually 2008. And last time we saw it above 5% was actually 2006. So there is a possibility that in the next 24 months, interest rates could start to fall again. And again, bond math from a 30,000 foot view is an inverse relationship. Interest rates go down, bond prices go up, and vice versa. So many of the new positions that we've bought at lower prices, there's a possibility that we'll see some price increase in the future there, which again, when we're looking at a return profile, we like to see. And then we also like the higher yield environment, which is the part that I would really focus on for most of our fixed income investors. We don't have to be as aggressive with the overall portfolio, so we can maybe reduce the allocation to stocks a little bit without sacrificing a lot in return over the short time period of things on the bond side, which can again make the ride for where some retirees want to go based on their plan and their goals, can make that a little bit smoother ride and a little better opportunity for them where there isn't as many chances to really make that real big mistake and blow up a retirement plan.
Right. Yeah. And remember back when the 4% rule was created in the early 90s, we were getting better bond yields than what we were a few years ago when bond yields were only 2%. So it does help things as a whole. Evan, there's a lot of confusion when it comes to bonds, and we hear about higher interest rates and then we hear about yields. How can our clients better understand how this impacts our thought process?
Yeah, I think there's all kinds of details that we could get into here, but an easy way to think about it is if you relate this to the bank and a loan. And most of us are familiar with having a loan from the bank, but in this case, the bondholder becomes the bank. So you provide your money up front, you receive interest along the way, depending on the bond, and you get your principal back at maturity, typically, generally speaking. And even as interest rates and prices fluctuate, as Vince mentioned, how they work inversely, your coupon payment stays the same. So that's a pretty straightforward way to think about it. Where bonds can get complicated is when things change before maturity. So in these times, they kind of act like stocks in a way. They're not as volatile, but they still have market value fluctuation, and that shows ultimately a difference before maturity in what you paid for it. Could be a premium, could be less. So as we've seen recently with those rates rising, selling before maturity could mean that you don't get your principal back. And again, that's not always ideal, but it can happen. So what we typically use in your portfolios are bond funds, not the individual bonds. So they function a little bit differently than, because they're a basket of bonds as opposed to just one individual purchase. So we have a strong understanding based on that of what the expected outcome will be from a return standpoint. But there's going to be some fluctuation because bonds mature in the portfolio and new bonds are purchased at times. So it won't always be exactly what is stated on any fact sheet or what you see, but we have a good understanding of what that's going to be. So the main takeaway really for the client is that bonds are a way to manage risk and to generate returns in the portfolio because, again, they're primarily math. And we made the decisions that we have in the portfolio to capitalize on some really attractive yields in the short term, as you and Vince have both mentioned, things we haven't seen in decades. And it still gives us flexibility to make changes if interest rates continue to fluctuate.
Vince, there's a part of this that we're looking at things from a perspective of possibly interest rates or yields falling in the near future. And you've touched on this a little bit, and that there's an inverse relationship between yields and prices. How would something like this, if we do see those interest rates fall in the first part of 2024, how would that impact bond holdings?
Sure. Again, 30,000 foot view. What I always tell people, yields and interest rate move in opposite direction of bond prices. So that's your starting point for a basic understanding of fixed income. So if yields or interest rates decrease, bond price increase, and vice versa. But there's a time component to this as well. Okay, and the longer amount of time you have, the longer duration that you have, typically the bigger, I guess, multiplier effect you see of those. So if you think of it as a teeter-totter or a seesaw, maturity would be where you sit on the seesaw, and then short maturities are close to the middle. So if you're closer there, you're not falling down as much, right? That's the idea. The longer that your seesaw is, or you're out on the edge of the seat there, those are the ends. You're going to see more fluctuation and more response to an interest rate change either way in price action. So again, the further you are out, the more that you move. The same happens in bond prices. So 1 year won't move as much as a 30, and at times 20 to 30 year bonds sometimes can move as wildly as stocks. So they don't even behave like quote unquote bonds as we like to think of them. So, and if that happens, we want to be able to take advantage of that. So part of what we've done and are looking to do is to take advantage of that. And again, the idea being, if you're thinking of this from a probabilistic perspective, you're not always going to get it right. There still is potential for interest rates to go up from here. But historically, looking at this level, we like where we're at, and we think that there's a good opportunity there, and we just want to make sure we take advantage of that.
So, Evan, the changes we made caught a lot of people's attentions. They've received a ton of mail with trade confirmations, and we certainly didn't do this to stuff mailboxes and scare people, but they do get irritated with the mail that this changes like this will generate. What can people do to reduce the amount of paper they receive? Yes,
first and foremost, we always want clients to be informed about what's going on in their account. So that's the purpose of getting those confirms. But if you prefer to not be as packed at the mailbox and get them in your email inbox, then we can make that change. We need an email address to set this up. And you can also elect to get those confirmations and other items electronically as well, even if you want to still receive your statements in paper format. So we have the flexibility to mix and match. And if you want to switch your delivery option, there's a few ways to do that. You can log in through Schwab Alliance or the Schwab client site, or Fidelity if that's your platform, and change your mailing preferences that way. Or if you prefer to just give us a call, shoot us an email, and we can get the required forms and paperwork ready for you. Whatever preference you have, we can make it happen.
Yeah, and please don't be intimidated by the access afforded to you by Fidelity or Schwab. They're really not that difficult to get set up, really not hard to figure out how to do that. And we can sit with you in our office and help you get that set up as well. So reach out to us and we can help you get things going in that direction. If you'd like to get deeper into the details about the changes we made in the bond portfolio, your advisor will be happy to discuss that with you. Simply give them a call or send them an email, and there's a form on our website you can fill out, and we'll be happy to reach out to you that way as well. I'd like to thank Vince and Evan for joining me today. Thanks for watching. Have a great week.